Ever wondered why the stock market seems to be on a roller coaster ride recently? These are indeed turbulent times for the stock market. The market's fluctuations and volatility have been nothing short of a whirlwind, leaving many to wonder what's behind the dramatic swings. From soaring highs to jarring lows, the stock market has seen some significant changes lately. Various factors are at play here: global events, economic indicators, corporate earnings, and investor sentiment all have a hand in shaping the market's performance. And then there's the elephant in the room: inflation. Yes, the I word that's been on everyone's lips. Inflation has a profound impact on the stock market, and its looming presence has been casting a long shadow over Wall Street. But what does this mean for stock futures? How does inflation tie into the bigger picture? As investors, we must understand the factors behind these changes. Let's dive into the concept of stock futures and inflation. What are stock futures and why are they important? Now let's delve into this. Stock futures are essentially agreements to buy or sell a certain amount of stock at a set price on a future date. They're like making a reservation at your favorite restaurant. You're securing your spot, or in this case, your stock, for a later date, at a price you agree on today. These contracts play a critical role in the stock market for a couple of reasons. Firstly, they allow investors to hedge against potential price fluctuations. Think of it like an insurance policy. You're protecting your investments against any sudden market changes. Secondly, they provide a sort of crystal ball into the market's future performance. How so, you ask? Well, if stock futures are trading higher, it often signals that the actual stocks will trade higher when the market opens. Moreover, stock futures have a broader economic impact. They can influence the direction of the economy by affecting investors' decisions and market sentiments. If futures indicate a bullish market, it could spur investment and economic growth. So, stock futures not only offer a glimpse into the future of the stock market, but also significantly impact our economy. So, we've got a handle on stock futures. Now what about inflation? Inflation is basically the rate at which the general level of prices for goods and services is rising, and subsequently purchasing power is falling. It's like when your favorite candy bar cost $0.25 when you were a kid, but now it's $1.50. Inflation has a significant impact on the economy. For instance, when inflation is high, the cost of living increases, and this can lead to less spending by consumers. This can cause businesses to suffer, leading to layoffs and a slowing economy. Recently, inflation rates have been on the rise. Now this can be worrying for investors. High inflation can erode the real returns on investments. Imagine you've invested in a bond with a 5% return, but inflation is at 4%. Your real return? Just 1%. However, some level of inflation is seen as a sign of a healthy economy. It shows that consumers are spending and businesses are thriving. But the trick lies in balance. Too much or too little inflation can cause economic instability. Inflation, therefore, is a key player in the financial world, influencing not only our personal finances but also the broader economy and stock market. Now that we understand stock futures and inflation separately, how do they interact? Well, it's a bit like a dance. When inflation rises, it reduces the purchasing power of money. This means that future earnings from stocks are worth less in real terms, which can lead to a fall in stock futures. On the other hand, if investors anticipate inflation, they may buy stock futures as a hedge. This is because stocks can often keep pace with inflation, providing a potential safeguard against the eroding power of inflation. However, it's not always this straightforward. Other factors such as interest rates and economic growth also play a role in this intricate interplay. For instance, high inflation could prompt central banks to hike interest rates, which might dampen stock futures. In light of these factors, investors should keep a keen eye on inflation trends and central bank policies. Understanding how stock futures and inflation interact can provide valuable insights, helping investors anticipate market movements and position their portfolios accordingly. As we continue to navigate the complex world of finance, understanding these concepts will empower us to make informed decisions and stay ahead of the market trends.